Okay, guys, we are going to now do chapter 9 of the study guide. This is called Business Entities. It's a small chapter. In fact, although it does have quite a few questions on the exam. But if you notice in that packet, that orange packet that you have, the last page is a couple of charts. One for the labor law that we did with the 4 major acts. Now on the other side of that sheet is the one with business entities. And if you look at that thing, you're going to have a bunch of characteristics on your left. Then you have the 5 big types of business entities. And then at the bottom, you have 5 smaller types of business entities. And when I'm usually in the review, I talk about the Power 5 being the top ones and the Group of 5 being the small ones if you're into sports and conferences and stuff like that. So we're going to go ahead and go over this, and then we'll go back through the study guide and kind of hit up anything that we missed in terms of little blurbs or something like that on the exam. So what we're going to do is we're going to start with sole proprietorship, and we're going to go down. We're going to go down the sole proprietorship list and go through every single thing. Now, first things first, whenever you're given a storyline scenario dealing with which business entity would work or which business entity would work best or which one is likely going to be used, the 3 main ones that you're going to have is going to be control, taxation, and liability. Those are going to be the 3 biggest things. Now, the other things could come into play in terms of number of owners and stuff like that, or what they can and can't do. But in terms of business entities, you need to really focus on those 3 things when a storyline situation occurs. So let's go over basically, we'll do column 1, sole proprietorship first, and then we'll move on. First things first, sole proprietorship. How many owners are there? There's just one. Now, they can have a number of employees, but there's going to be one owner, only one owner, possible number of managers, employees, whatever, but only one single owner. There's not multiple owners. So if you get a question that says one of the owners, plural, you know it can't be a sole proprietorship. It got to be something else. Okay? Next, there is no formality necessary. There is no formality necessary to make a sole proprietorship. You don't have to do anything under state law or federal law at all. You just go ahead and do it in terms of, oops, hold on, sorry about that. You have no formality necessary at all under state or federal law. Okay, the next thing is control. In a sole proprietorship, you as the owner, the one owner, have complete control over business operations. Complete control. Now, whether you give that to someone to do it for you or whatever, but you have complete control. You're going to be the one that makes the ultimate decision in how the business is going to be run. Now, you can let the managers do it, you can let the key employees do it or whatnot, but you have complete control over business operations. Now, the length of the business is interesting. It's until you either quit or die. If you die, the business itself is dissolved, it's ended, it's over. If you quit, then because there's no formality, there's nothing else you have to do. The decision is over, okay? Quit or die. Now, liability is where we get into the biggest thing. In terms of liability, what is the difference between limited liability and unlimited liability? The first ones we have are going to be unlimited liability. Unlimited liability, your personal assets can be seized to pay off the debts of a business, okay? Your personal assets can be seized to pay off the debts of a business. So what that means is if your business goes under and you can't afford to pay off your creditors or whatnot, they can seize some, if not all, of your private property, depending on the situation that you have. Now, you'll learn later in chapter 13 what they can and cannot do, and there's certain things that are going to be exempt, but for this test, you don't know that yet. All right? So unlimited liability, your personal assets can be seized to pay off the debts of a business. Then taxation. For a sole proprietorship, taxation is based upon single profit, based upon 100% of the total net profits. So you're going to pay taxes on all of it, that whatever your net profits is in the end. Okay? Now, that may be after all the expenses are paid and stuff like that. This may be your total, but you're going to be a single taxation system based upon your percentage of the profits. And since you're the only owner, it's 100%. Now, you got to remember that's net profits, because if you sell $100,000 but you have $70,000 in expenses, you don't pay $100,000 on taxes. You pay on the $30,000 on taxes, because that's going to be your net. All right, transferability. Of those Power 5, the top 5, it is going to be by far and away the hardest for transferability. Why is that? Because in order for someone to take over a sole proprietorship, because most sole proprietorships end within, say, 90% of them end within 3 years. So the reason why you would be able to get someone to take it on is because they understand the market niche. If they don't understand the market niche of your sole proprietorship, they're likely not going to be able to run the business effectively. And if you're doing well in your business and you decide to sell it, they better understand the market that they're in as well, or if not better than you do. If they don't, they're going to be in trouble. That and the other thing is taxation. It's unlimited liability. So their personal assets can be seized if the business fails. The personal assets can be seized and the business fails. They may not want to take it on, so it's going to be hard to transfer. Capital raising is also one of the more difficult ones as well. In terms of capital raising, the only way you're going to be able to get it of the big five, the power five, is by far the hardest as well. Why is that? Why is it that capital raising is going to become the most difficult? Well, you're the single owner. You're the only owner. And if you're the only owner, how can you generate capital to run your company? The best way you can do that is get a loan, maybe a small business loan or a personal loan. You have family and friends. You can run up credit card debt if you need to. You know, savings if you have any savings. But that's about it. Your money that's in the bank, friends, family may be able to help you out and stuff like that, but you don't have a lot available to you. Okay? So the difference between that and, say, a partnership is there's going to be more partners, and we'll talk about that a little bit later. Now, in the other points, every once in a while there's going to be 3 or 4 in there. There's going to be 1 or 2, and these are going to be key points on the exam. When we talk about business ownership and business entities, the sole proprietorship is the oldest form of business entity found within the United States. So if he gives you a question that says, the oldest form of business entity currently found within the United States has each of the following characteristics, except, or just each of the following characteristics, you're going to have to go through and answer those questions. 1 owner, no state formulation, complete control, unlimited liability, hard for transfer, hard for capital raising. All of those are going to be characteristic of it. So that is the oldest form. It is also the most common form of business entity found within the United States as well. It's the hardest, the most common form and the oldest. So when you have the most common form and the oldest, this tends to be the questions that get asked. The most common form of business entity is also the oldest form of business entity. You might want to note that for the test as well. So the things that we need to know about sole proprietorship is 1, single owner, unlimited liability. Their personal assets can be seized to pay off the debts to the business. There's no formality necessary. They have complete control over business operations, whether they give it to someone else to take over, but they are going to be ultimately in control over the organization. Single tax based on 100% of profits. It is hardest to transfer and for raising capital, but it is the oldest and most common form of business entity in the United States. Now, if he asks you a question about which type of business entity would work best, or characteristically the oldest form of business entity has each of the following except, those are the things that you need to know for sole proprietorship. The other thing is when he asks you a question about comparing and contrasting between the two business different types of business entities, and he'll say, what's the fundamental difference between a partnership and a sole proprietorship, or an LLC and a corporation, or something like that? You need to be able to know those characteristics for this situation. The next type of business entity we have is a partnership. There is at least 2 plus owners. So in your partnership under column 2, 2 plus owners. It can be multiple owners. It can be 2, but it cannot be 1. You got to have at least 2. All right. There is no formality necessary. There is none necessary to enter under state law for a regular partnership to be created. There's no formality. Control is going to be shared. And we're going to talk about a key term a little bit later on when we get to the end of partnership, but the control is shared. If there's 2 partners, say Andy and Bob, either one of them has a shared right to make a business decision on behalf of the partnership. It doesn't always have to be Andy, doesn't always have to be Bob. It could be Andy or Bob. Now, if Andy and Bob say to themselves, only Andy will make business decisions, that's fine. But to the third parties, to other business owners, the control is going to be shared, meaning if Bob did make a decision, the partnership would be held liable to that decision. For a partnership, You can, it'll end when you quit, die, or by agreement. You quit, die, or by agreement. Okay? Liability is once again unlimited for all partners, meaning now instead of just Andy and a sole proprietorship, Andy and Bob can have their personal assets seized because both of them, Andy and Bob, have unlimited liability, meaning their personal assets can be seized to pay off the debts of the business. Okay? Taxation. Taxation is single tax, just like a sole proprietorship, and it's going to be based upon your percentage of profits. Now, if it's Andy and Bob, and you don't have any agreement in place, it's probably going to be a 50-50 split of the net profits, and then you'll pay taxes based upon your 50%. Now, it doesn't have to be 50%. Andy could get 70, Bob could get 30, or you can come up with any term all you want, and you're going to pay taxes based upon that percentage. So Andy and Bob, if they say everything's equal, 50% each, you're going to pay taxes on the net profits. Andy will pay taxes on his 50%, Bob would pay taxes on his 50%. If Andy goes 70%, Bob goes 30%, that's perfectly fine. Andy would pay 70% tax rate, and Bob would pay for his 30% on the taxes. Okay? Transferability, it's usually going to have to be by agreement between the parties. It's going to have to be by agreement between the parties for them to make any kind of change. Now, under capital raising, it's a slightly easier than a sole proprietorship. Why is that? Because now we don't have Andy just in a sole proprietorship going after family, friends, savings, stuff like that. We now have Andy and Bob going after their money. So now they can get family and friends. Andy and Bob can do it. They can both get business loans or personal loans for themselves. They both have credit cards they could use if they need to. Now, other points for a partnership. The one that we have is least preferred method of business entity. So if he asks you which is the least preferred business entity in the United States, it would be a regular partnership. Regular partnership, not an limited partnership or not an LLLP that we'll get to later on, but a regular partnership. That is the least preferred method. Now, if he gives you a question once again about not only is it the least preferred method, but then he says characteristically, the least preferred business entity in the United States has each of the following characteristics. And then you go through, you're just basically going up and down that column and being able to answer which ones apply and which ones do not apply in a given situation. Now, we move from partnership to a limited partnership. We still have, in a limited partnership, 2+ owners, so that doesn't change from a partnership. But now in formality, we require at least a state statute. State statutory law, whatever state you do it in, is going to require some formality. You're going to have to file paperwork now for a limited partnership to be on the books. For control and non-control is going to come into play. Now, when we talk about the formation formality, state statute law, then we have, once we create it by state statute, you have 2 different levels of partners. And those 2 different levels of partners can do certain things and not do certain things, and can receive certain benefits and not receive certain benefits based upon what type of partner they are. Now, there are 2 types of partners. One is a general partner. The other one is called a silent or limited partner. And you use those interchangeably on the exam. Limited partner, silent partner, either one works. A general partner will typically if you look in that chart, you have 2 lines under control. The first one I would put general partner on. Now, how many general partners must there be? There must be at least 1. So I would put general and then in parentheses 1+. You have to have at least 1, if not more, at least 1 general partner. And general partners have control over operations. Okay? Whereas limited or silent partners, there must be at least 1, maybe more, 1+, has no control over business operations. So if we're talking about Andy and Bob in a regular partnership, Andy or Bob can make a business decisions because they have shared control. Any one of them can make a business decision. However, if it is a limited partner and Andy is the general partner and Bob is the silent or limited partner, then Andy can make business decisions as a general partner because he has control. Bob cannot make any business decisions. He is a silent or limited partner, has no control. There was at least 1 of each. We're good there in terms of that. So you have to have 1 general partner and at least 1 silent partner. The general partners have control over operations. Silent or limited partners have no control. So the question then becomes on a storyline possible scenario is, what if Bob is a silent or limited partner And then all of a sudden, once there starts making business decisions, well, then Bob goes from being a silent or limited partner to becoming a general partner. You can have more than one because you can have one plus, so it doesn't really matter. You are a silent or general partner then, okay? I'm sorry, you go from silent to general partner is what I meant. Silent to general partner, and now you have control over operations, but you're listed or you're thought of as a general partner. All right, the length is you can quit, die, or by agreement. Now that agreement is usually going to be within the limited partnerships, statutory writings, their filings and stuff like that, how you're going to dissolve in case of something happens. So you're going to have some kind of formality likely on if someone quits, if someone dies, or someone leaves the organization, the business, you're probably going to have that come under play with agreement placed in place under state statutory law. Taxation. Taxation is going to be single tax based on a percentage of your profits, just like we did with a regular partnership. However, those that are considered to be silent or limited partners get one additional benefit. They can recoup their initial investment before paying taxes on their profits. For example, if I was to say spend $50,000 of my own money, and I decide I want to be a silent or limited partner, and the business itself goes under, I am only going to lose my $50,000. That's my initial investment. It's gone. But they can't come after my personal assets. We'll talk about that with the liability status in a little while. But if the company renders a profit of, say, $70,000 is my percentage as a limited or silent partner, I can deduct the $50,000, get it recouped back to me, and only pay taxes on that $20,000 that I owe. Then I'm only paying taxes on $20,000 and not $70,000. I can choose to do that at least that first year. Other multiple years, I probably had to pay the full amount because I've already taken my recuperation that first year. All right. Under capital raising, it's going to be easier than it was with a regular partnership. And you have to ask yourself for multiple choice questions. Why is that? Because in a regular partnership, all partners, regardless, have unlimited liability. Their personal assets can be seized. So you have Andy and Bob. If Andy and Bob in a regular partnership have the business go under and they owe creditors, the problem is they're going to have their personal assets seized. Bob and Andy will have anything that they have probably gone. So say they get Andy, Bob, and then Charlie. Charlie is a rich man. Say he's worth millions. He doesn't want his personal assets seized. He doesn't want to control over operations. So he stays as a limited or silent partner. When he stays as a limited or silent partner, then this becomes the liability issue. In terms of the liability issue, then he is considered to be a silent or limited partner, and his personal assets cannot be seized. He has what we call limited liability. Limited liability simply means in the event of the ending of the business setting, whatever it is, business entity, the owner does not have his personal assets seized. A general partner, one that was in control of the operations, doesn't have that luxury. They're just like a regular partner in a regular partnership. They, as having control, can have their personal assets seized. So now we have Andy, Bob, and Charlie. Charlie, a rich man, decides he doesn't want to be involved in the business settings to protect his millions. If it protects his millions, the business goes under. Yes, he can lose his initial investment, but after that, he keeps everything else because his personal assets can't be seized. How is this going to help us in terms of capital raising? Easy. If now we have a bunch of Charlies with a lot of money that aren't willing to run the business itself, maybe they have other business interests and they just want to be a partner because they think it's a good idea and they can make a profit off of it, then they're going to go ahead and invest money, but only as a silent or limited partner. Their personal assets can't be seized. Therefore, you're going to get people with money maybe investing, whereas they would not invest in just a regular partnership. Therefore, you can get more money to raise for more capital. All right. In terms of other points you need, they file certificates of limited partnership, and then they dissolve. If the partnership gets dissolved for whatever reason, quit, die, or by agreement, or whatever reason it gets dissolved, limited partners are paid off first, and then general partners. Just note that for a little storyline scenario when he just asked if the event of a limited partnership ends between Andy, Bob, and Charlie, Who gets paid first? Any remaining balance after all creditors are paid. Well, after the creditors are paid, you'd be going to the limited partner first. Whoever that is, if I did it storyline, it was Andy, Bob, and Charlie, that would be Charlie. Okay, guys, I moved the computer back a little. I was getting a little too close to it. Anyway, we just finished limited partnership, the third column in the big five, the top five. Now we're into corporations. C Corp or regular corporations. C Corp is a regular corporation. The number of owners is from 1 to an infinite amount based upon how much stock. If only one person owns all 100% of stock, or if there's only one share of stock and I own it, then I am the only owner, correct? But you can have millions of shares out there. And if you have millions of shares, then there can be an infinite amount of owners depending on how many shares of stock are out there. So for the number of owners of a corporation, regular corporation is 1 to an infinite amount depending on how much stock is being sold. Formation formality, it is under state law. It's required to file articles of incorporation. We'll talk about articles of incorporation. We'll make another little chart at the very end of chapter 9 or the beginning of chapter 9 when we finish this chart, make a little smaller chart for articles of incorporation. Okay, for formation formalities under state law, file articles of incorporation. For control of a corporation, it is a centralized management structure. And what that simply means is with a centralized management structure, there's a level between the owners, the shareholders, the stockholders, okay, and the officers and managers, directors, officers, managers that run the day-to-day operations of the corporation or the business. There's a centralized management structure, meaning there's a separation between owners and management, okay? How long does a C Corp or a regular corporation last? It lasts indefinitely. It has perpetual continuity of life. What that simply means is in the event of a death of a shareholder, the corporation continues on. Now, if it's a major shareholder, yes, there's going to be some obvious major problems associated to that. But if I own 5 shares of Pepsi and I was to die tomorrow, Pepsi's not going to be like, whoa, we lost a shareholder, we're done. No, they're going to continue on. Now, depending on how much stock you have, is going to how that death of an owner is going to affect the business. But from a business setting, once you create under Articles of Incorporation filed with the state office, state law, then you've created your own separate legal person in the eyes of the law. And if you've created that separate legal person in the eyes of the law, then it has perpetual continuity of life, regardless of the actual person that owns stock into it. So take, for instance, me running a lawn mowing business. So Mark's lawn mowing business is a sole proprietorship. After a while, I realized, hey, I don't want to have unlimited liability in case something goes wrong. I want to go ahead and have limited liability. Well, I can, make it a limited partnership, take on some partners, but then I wouldn't have control over anything. So I go with a C Corp. I go from a sole proprietorship to a corporation by filing articles of incorporation. I issue 100 shares of stock. I keep all of them. So now we have me, the person who owns the stock, and we have the C Corp, Mark's Lawn Mowing Business Incorporated, who is going to be the corporation. If I die, I own all the stock. And that corporation is probably not going to do much in terms of lawn mowing because I'm dead. However, the business entity itself would survive even if I do not. So Mark dies, but Mark's Lawn Mowing Business Incorporated as a business entity continues on even in my death. So say I own 70% of the stock and someone else owns 30. If I die, that 70% of stock is going to go to one of my heirs and they can either sell it off or whatever, but the corporation would continue on. All right. Liability. It is limited liability for all corporate stockholders, whether you're called a shareholder, a stockholder, a corporate owner, however he says it on the exam. If he gives you a storyline, it says Barney, a stockholder, Lily, a shareholder, Marshall, a corporate owner. All of those are the same thing. They own a corporation, which means they own stock. Now, if it's publicly traded, that's chapter 10. We'll talk about that a little bit more. But if it is a corporation, then all owners have limited liability, meaning their personal assets cannot be seized to pay off the debts of the business. Now, there is one exception to this rule, and you might have it on the exam called piercing the corporate veil. If you see the term piercing the corporate veil, usually in quotes or something like that, that means that probably fraud was committed and somebody who might have limited liability under a corporate setting would probably be able to have their corporate veil pierced And now that means whoever had committed fraud or something like that could have their personal assets seized. But as a general business entity, your personal assets cannot be seized to pay off the debts of the business. So if Pepsi, I own 5 shares, goes under and they owe billions upon billions of dollars to creditors, they're not going to come after my savings because I own 5 shares of Pepsi. It's protected. Now, if I own 50,000 shares of Pepsi and I committed fraud, then maybe they could go after me by piercing the corporate veil. All right, taxation. C Corp is one of the main of the big 5. It is the only one that has double taxation, meaning you pay taxes at the business level, the corporate level, and then you pay taxes as a person that owns stock based upon dividends that you get every year and or capital gains when you actually sell the stock for a profit. So the corporation, say, Mark's Lawn Mowing Business Incorporated makes $100,000. As a corporation, the corporation is going to be taxes on their profit. That's one tax. Then whatever dividends I as a shareholder get and or how much my stock goes up and I sell it, if I make $10 in dividends a year and I make another $70 on the sale of some of the stock, I've made $80. Technically, I would have to pay taxes on that, whatever the tax rate would be for $80. Now that's $80,000. I pay the tax rate for $80,000. But you're going to pay taxes not only at the corporate level for the business itself, but also the individual owners in terms of dividends or capital gains once they sell the stock on the stock exchange. And that's what we come to with transferability. Transferability of corporate stock is usually done on a secondary market. In this case, a stock exchange. Now, this could be for publicly traded corporations. It's usually going to be under like a NASDAQ, New York Stock Exchange, or some of the global ones like in Sydney or London or something like that. But a stock exchange is just a secondary market. So transferability is going to be done through the secondary market. In terms of capital raising, of the big 5, it is probably the easiest to raise capital. And why is that? Because it is the easiest to raise capital because if you simply need more money, all you do is sell more stock. Okay, we need $500,000. Okay, we're going to put out 50,000 shares on the open market at $100 a share. There's our $500,000. Okay, so that's how they can do it. They're easy to raise capital by just selling more stock. Now, the stock price will probably plummet for a little while in terms of each individual owner because you flood the market. But in terms of raising capital, that's one way to do it. There's many other ways to do it, but that's one of the easier ways to do it as well. All right, and other points. Chapter 10, which is the next chapter we're going to go over after we do this Chapter 9 video, is going to have a lot more information on publicly traded corporations and go much more in depth. But for this chart itself, the things that we need to know is a corporation is the separate legal person in the eyes of the law. It is a separate legal entity in the eyes of the law. It has the most total revenue conducted within the United States. The most total revenue conducted within the United States. It's not the most common form of business entity. It's not the oldest one, but it has the most total revenue. So if you put all the revenue, corporations would vastly exceed all their business entity types in terms of revenue generated. Okay? But the most common form, sole proprietorship, if you lined up every single business and just ticked them off for every single type of business, sole proprietorships would have the most, not the most total revenue. The last other points that you need to know, and you might want to put this on one line or you can put it on separate lines. Connecticut was the first state to incorporate. Connecticut created in 1837 the first incorporation laws in the United States. Now, they originally started it with the East India Trading Company and the mother country and all that state, the East India Trading Company. But for the United States, Connecticut was the first state to allow incorporation laws. Now, the one is the easiest to deal with restrictions and the easiest to provide uniformity for all other ways of doing corporate law and stuff like that. Delaware is considered to be the easiest form. So the 2 states that you need to know for corporations, Connecticut being the first and the easiest in terms of uniformity and all that stuff, most states adopt Delaware incorporation laws because it has the most codified links and stuff like that on how it works. All right? The last form of business entity under the big 5 is an LLC. Now, if you're going on a question and you have no idea the answer on the exam, no clue, and you're just going to guess, I would go LLC before any of the others. Now that's when you have no clue. You can make an educated guess. It's always good to go with that. And the reason why we go with LLC, one, it's the newest form of business, but there's going to be other things in the study guide that after we go with this chart, we're going to talk about little things, and almost all of them deal with LLCs in some way, shape, or form. Okay? How many owners do you have in an LLC? Many states it used to be 2, but now it's only 1, so it's 1 plus. And in parentheses, you might want to put members because they are called members in an LLC. Now, why is that important? Because if it gives you a storyline scenario and you use the word sole proprietorship or partnership or general partner or limited partner or silent partner or stockholder or shareholder or corporate owner or member, he's giving you in the storyline the exact business entity that is being used, because all those terms go with only one type of business entity: sole proprietorship, partnership, general partner, limited partner, corporate owner, stockholder, shareholder, member. They all let you know what business entity we're talking about. So an LLC are members. They are created under state law as well by filing articles of organization, not articles of incorporation. That was corporate law. Articles of organization is under the LLC. We'll talk about that a little bit later with a second chart we're going to make in regards to the difference between C Corps, regular corporations, and LLCs in terms of how they do business and stuff like that. Just a brief little chart there. Under control. Control can be done either by manager managed, which is similar to that centralized management structure where there's a separation between the owners, i.e. the members, and the people that run the business. That would be manager managed, similar to a C Corp. There's a separation of layers between owners and people that run the business. Then there's also called member managed. Member managed means a select member or a group of members will run the business. It'll be much more like, say, a limited partnership, and then only a select few have general partner capabilities. It's only going to be a few members, maybe even only one member, that is going to be able to run the business. However, all members will have limited liability, whether they run the company or not, run the business or not. And we'll get to that when we get to liability. In terms of length, in most states now, it is perpetual continuity of life. It doesn't end. An LLC does not end. Now, in a select few states, some minority states, so to speak, the limit is still 30 years. Now, he has a question as test bank that's been there for years, and he has one that just says, how long does an LLC last? And he goes 5 years, 10 years, 15, and he gives you a bunch of numbers as a number of years. And there's no unlimited on the multiple choice. It's an old question that doesn't really apply unless he changes it in some states on the multiple choice answer. But if you're going to get that and you have no perpetual or long unlimited, you're going to pick 30 years. That's going to be probably the answer to that question. If it says in some states, then yes, the answer is 30 years. If it says in most states, you better be looking for something unlimited, meaning the LLC can last an unlimited amount of time. All right, for all members, whether they are member managed or not running the business itself, an LLC member has limited liability, meaning their personal assets cannot be seized to pay the debts of the business. In terms of taxation, it is single taxed based upon your percentage of the profits. That is the exact same as a regular partnership. Single taxed based upon your percentage of the profits. Whatever your percentage is, you're going to pay single tax. That is just like a partnership and an LLC are taxed the exact same. In fact, an S Corp down below in the group of 5, the first one in the group of 5, are also taxed the same. So a partnership, an LLC, and an S Corp are all taxed the same, single tax based upon your percentage of profits. All right? Transferability is going to be in the company regulations, also called the company agreement or operating agreement. They'll be listed under the company agreements, company regulations, or operating agreements, however you want to say it. Depending on the way the state is, you come up with that term. Capital raising will also be determined under that operating agreement, that company agreement, the company regulations, whatever it is used statewide, the name of it. Okay? In other points, okay, it is the newest of those big 5. Of those 5, it is the newest form. It has different names. It can go under LC, it can go under LLC, it can go under L.L.C, all that stuff. Those little words at the very end can occur. If you get an LP, that is limited partnership. If you get an LC, that is just like an LLC, a limited liability company. So if you see the word LP at the end of a business name or an LC, they are different. LP is a limited partnership. That's column 3, the middle column. And then you have LLC, could also be called LC, limited company. And that would be the column 5, LLC. Okay. Now, what was the first state to adopt LLCs in the United States? That would be Wyoming. Wyoming would be the first state to adopt. Germany would be the first country that created LLCs. Do not get this confused with LLPs, which we'll talk about in a little while. And LLPs, Texas was the first. Wyoming was the first LLC. Connecticut was the first C Corp, regular corporation. Delaware is the easiest for restrictions of C Corps. Texas is the first LLP. All those states could come into play for multiple choice questions. Those are usually the easier questions if you just memorize that stuff. Kansas would be another state you're going to need to know later on in chapter 10. You also have Montana, which is theoretically a state that you need to know for chapter 12, which got bumped from this exam, but nevertheless, it might be a multiple choice answer. So Texas, Connecticut, Delaware, Wyoming, Kansas are all ones that are going to be on this test, along with possibly Montana, although that won't be an answer for this exam. That would be an answer for a chapter test 4 exam. All right, now we are into the 5 group of 5s at the very bottom. These are smaller business entities, and usually, for the most part, he just asks about the characteristics of each, and that's it. He doesn't compare or contrast. If it's a comparison contrast or which business entity would work best, usually it's those group of 5 questions at the top, the Power 5, and he's just deciding between those 5. If he's asking a question about the bottom 5, it's usually a specific question about that entity itself, and you just need to know the answer. All right? S Corp. S Corp is a regular corporation, but in addition to filing the articles of incorporation, they file an additional subchapter S form. In this subchapter S form, it says they're going to run a business slightly different than a C Corp with certain other restrictions in order to get this S Corp certificate. 1, you can have no more than 100 maximum individual shareholders. It can be maybe an estate or a trust, but it's got to be an individual. So another business cannot own an S Corp. An LLC cannot own shares of an S Corp. A C Corp cannot own shares of an S Corp. A partnership or a limited partnership can't own shares of an S Corp. It's got to be a person. An LLC can own stock in a C Corp. A C Corp could theoretically be a member of an LLC. It doesn't have to be an individual. But when it comes to an S Corp, they must be an individual. A state's trust could work, but it's got to be an individual. And it's a maximum of 100. It used to be 35. It's now 100. Okay? There's a single class of owners. So like a C Corp, and we'll talk about more of this in chapter 10, you have in a C Corp, you have maybe common stockholders and preferred stockholders. So you have different levels of ownership, preferred, common, stuff like that. In an S Corp, it is a single class of owners. And they must be non-alien, meaning they must be U.S. citizens and individuals, estates, trusts, and stuff like that. But they must be individuals. As an S Corp, they are going to be single tax. So by filing that subchapter S form and saying you're going to have a maximum number of individual shareholders, you're going to stay a U.S. business and you're not going to have but a single class of owners, you take away the double taxation of a C Corp and you go to only single taxation based upon those owners' percentage of profits. So similar tax to a partnership or an LLC. But it's single tax, not double tax. And an S Corp must be a domestic business. Okay? Under P Corp, that is for professionals. A P Corporation is for professionals. It gives limited liability to all the professionals. So if you have a doctor's practice that decides to become a professional corporation, then all the doctors receive limited liability. All the lawyers, all the accountants, all the engineers, if you make it a professional corporation, have limited liability, meaning their personal assets cannot be seized. And if you think about it, these are some of the jobs that are going to be a little more, they're going to have a little more wages compared to other jobs. Lawyers, doctors, engineers will get paid more. They may want to protect themselves, so they have limited liability. Except limited liability does not exist for malpractice cases. If a case of malpractice by the engineer, by the doctor, by the lawyer, they are not protected under the law. All right. P Corps still must be professionals, by the way. It started as professionals, must still be professionals. Now, the closely held corporation, also known as a family corporation, is family style. There's a low number of owners. It is created under state statutory law, just like a regular C Corp. It has double taxation, just like a C Corp, but it's likely not going to be publicly traded on the secondary market. There's going to be a low number of owners, and those low number of owners are going to keep it in-house. Think of it like sometimes like organized crime. That would likely be more like a closely held corporation. Double taxation, created under state statutory law, family style, low number of owners. This one has been moved away, and now we're going to more of an LLC where it's more member managed. So you don't see a lot of closely held corporations very much any longer. All right, the last two are LLP and LLLP. The first thing, limited liability partnership. LLP is different from a limited partnership, and it's different from an LLC because it's a limited liability, but it's a partnership. Texas was the first state to adopt it. They first started with professionals in accounting. Okay, so it first started with professionals in accounting. Now you don't even have to be professional for it to work. An LLP does not require professionals. It used to be for professionals, but now anyone can do it. A P Corp, we talked about earlier, requires it still be professionals. So an LLP was originally professionals, P Corp was originally professionals. P Corp still must be professionals. LLP no longer has to be professionals. Texas was the first state to adopt it. In fact, accountants in Texas were the first state to adopt it. Liability for all the LLP members or the owners is going to be based upon limited liability, based upon state criteria. There's going to be certain criteria for each state. The last one is LLLP, and I doubt very seriously you're going to get this on the exam. It's very limited. It's not been used very much. It's untested in the waters and stuff like that. But what we're taking is a limited partnership, and we're saying we're going to go with limited liability, limited partnership. So all we're going to do is take the LP from column 3 above, and you're going to basically say, as a general partner, you still have control, but you have limited liability, because now the general partner also gets limited liability as well. The general partner also gets limited liability. They can still have control, but they still have limited liability, meaning their personal assets cannot be seized. So they get the benefits of still having control like a limited partner would, or a general partner would in a limited partnership, but they do not have the negative or the disadvantage of having their personal assets seized if they don't pay the debts, because an LLP takes care of the limited liability status for a general partner, even if they have control. Untested, very rarely used, not very limited, but Texas was not the first state to adopt. It doesn't say which state it is, but don't get that confused with LLP versus LLLP. All right, that is the chart right there that you have. We're going to make another chart dealing with the difference between a regular corporation and an LLC. So if you want to get a sheet of paper out, it's basically going to be a 3-column chart, okay? The first column is going to be formation. How is it formed? How is it created? And we already have that in our chart that we just did. A C Corp is going to be under state law filing articles of incorporation. Okay, it's going to be created by filing under state law or filing articles of incorporation. An LLC will be created, if you want to put that, by filing under state law, once again, articles of organization. Articles of organization. Now, these are called articles of formation in Texas, and that has been a test question on previous exams. Articles of formation are the same thing as articles of organization. We just know that it's being done in Texas. And you file these with the proper court clerk. In this case, the court Secretary of State in the state of Texas. That's the court you're going to, the person you're going to file. The paperwork filed with the Secretary of State for articles of formation in Texas. Articles of formation, articles of organization are the same thing. The next row that you have is the how it is, the birth certificate, how is it created, okay? And in a C Corp, its birth certificate is the corporate charter, the corporate charter, all right? That is going to be for a C Corp, the corporate charter, all right? For an LLC, that is going to be a certificate for a limited liability company. Limited liability company. And when we talk about that, that also has some other implications. I'm training my thought ahead of time, but the other implications on that is that it's going to come into play for dissolution, but we'll talk about that a little bit later. The third one is, how is it going to be governed? In a regular corporation, governance is going to occur through its bylaws and its articles of incorporation, but its bylaws are going to govern. How is an LLC governed? An LLC is going to be governed by its operating agreement, also known as a company agreement. And in Texas, this is called company regulations. So in your chart, you should have a C Corp. How is it created? Articles of incorporation at the state level. How is it going? The birth certificate is going to be the corporate charter. And then how is it going to be governed? It's going to be governed by its bylaws in conjunction with its articles of incorporation. For an LLC, it is created through articles of organization called articles of formation in Texas, filed with the Secretary of State. It is going to be a certificate of limited for the certificate for the limited liability company is going to be its birth certificate. And then for its governance is going to be the operating agreement, the company agreement, also known as the company regulations in Texas. And I would note the difference between company regulations and operating agreement. There is no real difference other than one is basically saying it's for Texas. That is a quick two-column chart on three different things for a C Corp and an LLC that, in addition to that chart that we already made above, can give us some other little factors as well. Now, when it comes to Chapter 9, in terms of the study guide, we've done most of it. We're going to go over just a couple of little things real quick, and then we'll be done with Chapter 9. If you look on page, let me find the page of the study guide. Sorry. If you look on page of the study guide, you have all the factors in deciding what type of business entity at the very top of page 251. Those are the factors that are on the left-hand column of the chart that we made for the most part. Most all of those are there, okay? And then it goes through the history of the different historical organizations for about 3-4 pages. We've done all that in our chart, so we've got almost all of that stuff there, so we don't have too much that we need to go over there. S Corps is at the top of page 254. We went over that, but there's some stuff on S Corps right there. All right. Then at the bottom of page 254, it talks about LLCs. All right. LLCs were first adopted in what state again? Wyoming. LLPs would be Texas, but LLCs was Wyoming. Now all states have them. They all have different regulations, but for the most part, they're the same thing. They file articles of organization, proper state officials, Secretary of State, called articles of formation. That's on the middle, the bottom of page 255 of your study guide. On page 256 of your study guide, it says what should be in the LLC. Their certificate of formation and all that stuff must contain. The articles of organization, articles of formation must contain the name of the company along with any abbreviation you're going to use. And then at the very top, B through G on page 256. Just memorize that. Memorize that. Okay? The birth certificate is the certificate of organization. I may have said certificate of LLC. I meant certificate of organization, so fix that on that little chart. I think I said certificate of organization once, and I think I maybe said certificate of LLC. It's a certificate of organization. Okay? It is the birth certificate for the LLC. Then you have the operating agreement, all that stuff. It's called company regulations in Texas, company agreement as well. That's on middle of page 256. Then you have dissolution. The dissolution of an LLC can occur when the fixed time periods elapse. If it's 30 years, then after that, it can end. If you've done everything in the operating agreement, it can end. If the members ask for it to be dissolved, it can end. If there's no members left, they've all left, then the LLC can be dissolved. Or if the judicial branch issues a decree ending the LLC. Those are all ways that we can dissolve an LLC. If that happens, creditors are paid off first, and then the owners receive any money that's left over after that. Okay? Dissolution, there's articles of dissolution to be filed. Certificate of dissolution terminates the LLC. The last question that's been on previous exams, I think it's one in the back of the study guide, is what types of businesses cannot be LLCs under state law. State laws do not allow banks that are insured by the FDIC at the state level. It does not allow certain foreign entities. It does not allow joint stock associations, and it does not allow insurance companies on page 258 of your study guide. Okay? I mean, you can memorize all four of those because it might be one of those multiple choice answers. But remember, for storyline scenario, if you're given an insurance company or a state bank insured by the FDIC, it cannot be an LLC. So he says, which of the type of business entities could work? Those couldn't work in that given situation. All right, LLPs are there with the Texas on page 258, and then the LLLP is at the very end of page 259 of your study guide. Now, one of the good things about the new study guide that y'all have is better font, and typos have been corrected, and a couple of things have been added. He forgot to always put in the chapter 9 questions, and now you have them in the back of the study guide. Question number 3 on page 262. Those are some of the style questions you're going to see where it gives you a scenario and says which business entity would work, which business entity would work best, which of the following could work in this situation. Those are the storyline scenarios that you may get. So number 3 could be made into a storyline scenario. When I talked about, sole proprietorship is the oldest form. It's the most common form. So if I change number 5 on page 262 of the study guide and said, which of the following are true about the oldest form of business entity in the United States? That's the exact same question. The most common form of business entity in the United States? That's the same question. The most total revenue in the United States? That's now characteristics of a C corp. Okay. LLCs, number 9. LLCs began in Germany. Which state did it first? That would be Wyoming. Just to let you know there as well. So you've got all those questions. But anything, if you have like number 17, number 18, where he's asking about specifically maybe one row on our chart, like about limited liability, unlimited liability, you can answer that question by just going across the row, those big 5. Okay? If you have any questions, feel free to text me, email me. But otherwise, we're going to end the video for chapter 9. The next video will be chapter 10.